Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone out there for supporting the channel. All the viewers, all the subscribers, immensely appreciate the support. Today I want to jump into the portfolio to detail a strategy I have been using with Ford, a strategy that nets a rate of return just over 10% with essentially no risk to the portfolio. If you guys have watched some of my recent videos, you know that I have been doing covered calls, essentially selling off contracts on stocks you already hold in the portfolio. By selling off those contracts, you get a cash payment credited to your account, and combining that with the dividend that Ford currently gives its investors, the rate of return is 10% plus, and the risk is essentially nil. No risk because I am holding this stock for the longer term. If the price of the stock does get up to the strike price of my contracts, those contracts that I get a cash payment for, I still make a positive swing trade and still make a rate of return while I'm holding that stock. So let's kind of scroll down here. You'll see that new contract in the portfolio. In the middle, you see $12 call, 1/18/19 is the expiration date with 35 sells. If we click on that order, this options ordered here, under position, you can see a negative 35. Essentially, that means I have sold off 35 contracts. As a reward for doing that, you can see average credit on the bottom right, 56 cents per share. Remember, every contract is 100 shares, so I essentially sold off 3,500 shares in the portfolio. If we take a look at the payment on the bottom here, again, $12 call, sell, 1/18/19 is the expiration date. You can see today's date as well as a credit of $1,960 to the account. So by doing this contract, I got accredited $1,960, and what I'm essentially doing now is obligating myself to selling Ford at $12 on or before 1/18/19 if the stock does trend up to that price. You can see in the bottom left-hand corner, current price is $11.50 per share. So I'm getting $1,960, but I'm also collecting the dividend on Ford while I wait for this contract to expire. So $1,960 divided by the price I paid for this stock, it's a little bit under $11 average cost basis for that 3,500 shares that I sold off here, or at least the contracts on those shares that I sold off. The shares are still in my portfolio. I still own those, but if the stock does get up to $12 or beyond, I'm obligated to sell off the stocks at the price of $12. So I have 3,500 shares that I have sold contracts on. I got $1,960 for those stocks. Cost basis just under $11. If we round up to $11, essentially I have $38,500 of equity in this trade. So if we divide 1960 by 3850, that is essentially a little bit under a 5% rate of return over 12 months. But again, the expiration date is 1/18/19, so about 8 months or so, 2/3 of a year. If we take that into consideration, the rate of return is just under 7.6% for that payment. So if I do nothing but hold this contract until expiration date on January 18th, 2019, it's a rate of return of 7.6%. But if you also factor in the to that equation the fact that Ford, we take a look at the statistics here, it's a current dividend yield of 4.804%, with the special dividend this year just over 5.2%. Let's round it to 5%, and then take half of that, 2 dividend payments, 2 ex-dividend dates that I will receive from now until that contract expires on the 18th of January. There's another 2.5%, so 7.6 plus 2.5, over a 10% rate of return, regardless of what the stock trades for. So that is the strategy I'm utilizing with Ford, essentially now making 10% plus rate of return while I hold the stock in the portfolio. And if the stock does trend up to $12, I will sell the stock off for that amount and still make a positive swing trade with essentially no risk to the strategy. The only risk is the upside potential. The most I'll ever be able to sell Ford off for is $12. If the stock goes up to $14, for example, I'm still required to I'm still required to sell the stock to another investor for $12. So the most I can get by selling off this stock is $12. But In the interim, I'm making over 10% rate of return while holding the stock, and I'm more than comfortable holding this stock because I don't think it's going to be getting up much over $12 the rest of this year. Just the way the car business works, I don't think that's going to be happening. It could happen, and yes, the upside potential is limited, but I'm willing to take that risk because there's really no risk other than that upside potential. If the stock starts trending down, I could easily buy back those contracts. Let's go back to the options contract here. You can see currently it's trading at 57 cents per share on these contracts. If the stock, for example, were to go up to $14, $15 or so, that contract price would go way up as well because essentially we'll be able to buy for it for $12 when it's trading for $15. So every stock that you buy for $12, you can turn around and make a $3 trade if it's, for example, trading for $15 on the open market. However, if this stock starts trending down, let's say from the current price $11.50 to, let's say, $9.50, the market value goes down tremendously as well because that the probability of you being able to buy for it at $12 and make a profit goes way down. So I could sell those, or excuse me, buy those contracts back and then sell off the stock. So essentially there is no risk in doing this strategy other than the limited upside potential. So if you don't think a stock is going to be going up that greatly, a great strategy to utilize, as well as a strategy to utilize if you're willing to get out of a stock at a particular price. So that's what I've done with Ford. Again, rate of return greater than 10% while holding the stock, both off the cash payment I got from selling off the contract, the options contract, as well as collecting the very nice dividend on Ford while I wait for the contract to expire. So that's what I'm doing with Ford. Please let me know if you guys have been doing a similar strategy with the stocks that you hold in your portfolio. I like this strategy because for buy and hold stocks, you're going to hold those in the portfolio anyway. You're really not focusing on the price of that stock. And yes, there is limited upside potential, but overall, I'll still be able to have a positive swing trade. I will still keep that payment, that cash payment for making the contract, and I will continue to collect dividends on the stock while I wait for the contract to expire. Or if an investor who bought those contracts from my portfolio wants to buy the stocks from me, I'll have to go ahead and sell off, but it's still a positive swing trade. I still get dividends, and I still keep the full amount of the cash payment for making the options contract. So just wanted to quickly go through this strategy. I know there's been a number of investors on the channel wondering exactly how I'm utilizing covered calls or the option strategy that I've talked about in some of my prior videos. So that's how I'm doing it. Currently doing it with Ford as well as IRM and a couple other of the holdings in the portfolio that I have over 100 shares with. Again, for new investors on the channel, for investors with smaller portfolios, you do have to have 100 shares minimum to utilize this type of strategy. So just wanted to quickly go through this strategy. If you guys have any questions about it, please let me know in the comment threads down below. And not to make the video too long, I'll kind of end it here. Again, if you guys have any questions on this strategy, on any of my videos, please let me know in the comment threads down below. I'll do my best to get back to you guys as quickly as I can. So kind of with that, I'll end the video, and we'll see you guys next time.